Okay, so February 2024, the United States quietly, and I mean quietly, moved 2 aircraft carrier strike groups into the Persian Gulf at the same time. Now, if you don't know what that means, let me put it in perspective for you. That hasn't happened since the Iraq War, not once. And here's what got me. Nobody on financial TV said a word about WHY. Not one person sat down and explained what that actually means for your money. And I'm sitting there like, are you serious right now? Because if they had, if just one person had broken it down properly, you'd immediately understand why your oil prices, your grocery bill, your mortgage rate, and honestly your whole retirement account are all being influenced by a tiny stretch of water that most people have never even thought to Google. So let's fix that today. 21 miles. That's how wide this strait is at its narrowest point. 21 miles. And through those 21 miles every single day flows 20% of the entire world's oil supply. Let me give you a picture that'll stick with you. Forget geopolitics for a second. Forget news anchors and government statements. Just imagine a highway. One highway, the only highway out of town. And at the end of that highway, there's one toll booth, one barrier arm, one gate. Every truck coming through that gate is carrying oil. Saudi oil, Kuwaiti oil, Iraqi oil, UAE oil. All of it has to pass through that one gate. Now, who's running the barrier arm? Iran. And here's the kicker, there's no back road. There's no alternate route. If that barrier drops, every single truck stops. And every city downstream that depends on what's in those trucks starves. That's the Strait of Hormuz. And that right there is what's quietly controlling your wallet. Now, I know some of you are already thinking, okay, but what does some random stretch of water in the Middle East have to do with me? And I get it, I used to think the same thing, but stick with me here because this is where it gets personal. This isn't a foreign policy problem. This is a YOU problem. Right now, this month, this year, let me tell you about Daniel. Daniel's 29. He's an electrician out of Columbus, Ohio. Regular guy, not someone who's obsessing over markets every day. He just wanted to do the right thing with his money, so he did what everyone told him, put money into a diversified index fund every single month. Consistent, disciplined, exactly what every finance influencer, every advisor, every money tips page told him to do, and honestly, it was working. January 2020, his portfolio is up 18%, he's feeling good. He's proud of himself, he's thinking he's got this figured out. Then 3 months later, oil goes negative, like actually negative, for the first time in history. People were being paid to take oil off someone's hands because nobody had anywhere to store it. And Daniel, his safe, diversified, do everything right portfolio dropped 32% in 6 weeks. 32%. Not because he made a bad call, not because he panicked and sold at the wrong time, but because of a supply shock that started 7,000 miles away, in a body of water he'd never heard of. And that's what kills me about this whole thing. Daniel did everything right, by the rules of a game that nobody told him was connected to something much bigger. If he'd understood the Hormuz equation, even just the basics, he would have seen it coming. He would have been positioned before the panic, not waking up to a 32% loss wondering what just happened. And that's really the thing I want you to walk away understanding today. Geopolitical risk isn't some nerdy foreign news story you scroll past. It's a tax, an invisible tax on your net worth. And it gets collected whether you're watching or not. So here's where most people get this wrong. And I say most people because honestly, this includes me for a long time. The standard advice, the stuff everyone repeats, goes something like this. Diversify your portfolio, hold long term, don't panic sell, buy the dip. And look, I'm not saying that advice is wrong. I'm saying it's incomplete. And in a world with real supply shocks and real geopolitical risk, incomplete advice doesn't just underperform. It quietly destroys you. Here's the problem with just diversify. Diversification protects you when anything goes wrong. Apple struggles, Amazon holds you up, tech drops, healthcare saves you. That's the idea. But what happens when a geopolitical choke point gets triggered? Everything drops together. Energy spikes, shipping costs explode, manufacturing slows down, consumer goods get more expensive, airlines start bleeding money. Every single domino falls in the same direction at the same time, and your diversified portfolio gets hit from every angle simultaneously. Let me give you a real example so this isn't just abstract. December 2023. The Houthis, who are backed by Iran, by the way, start attacking cargo ships in the Red Sea. Now shipping costs don't just go up a little bit, they go up 173% in 6 weeks, 173%, and you might be thinking, okay, that's a shipping problem. That's not my problem, but here's how it becomes your problem. That cost doesn't disappear, it gets passed along into the price of the products on those ships, which end up in the stores you shop at, which show up in your monthly expenses 60 to 90 days later more expensive, and if you ordered online, probably 3 weeks late. The SD, Louis Fed actually published research on this. They found US inflation has a 0.6 correlation with global oil supply shocks. That's not a weak relationship. That's a strong one. What it means in plain English: when something twitches near the Strait of Hormuz, your grocery bill feels it within 90 days. So why isn't anyone talking about this? Why isn't your financial advisor bringing this up? Why isn't it on the front page of every money podcast? I'll tell you why. Because understanding this requires you to zoom out, to think globally, to connect dots across geography and markets and geopolitics. And an investor who does that is harder to panic, harder to manipulate, harder to extract fees from. A panicking, reactive, myopic investor. That person is incredibly profitable for brokers, not for themselves. All right, I'll be real with you. In about 3 minutes, I'm going to walk you through the exact framework, the actual move that flips this whole thing on its head. The positioning strategy that lets you benefit when the toll booth drops instead of getting blindsided by it. But I need you to see one more thing first, because there's a piece of advice out there that sounds really reasonable, and it's quietly working against you. Stay with me. So here's the trap that I see so many smart people fall into, and these aren't clueless people. These are people who read. People who are genuinely trying to make good decisions. They hear, geopolitics is unpredictable. You can't time markets around world events, just stay the course. And honestly, half of that is true. You cannot predict the exact moment something happens. Nobody can. I'm not going to sit here and pretend otherwise. But, and this is the part people completely miss, you don't need to predict the event. You just need to understand the structure. The Strait of Hormuz has been the world's most critical oil choke point for over 40 years. The geography hasn't changed. The players are largely the same. The dynamics repeat: 1980, 1987, 2011, 2019, 2024. Every single time tension spikes in that strait, oil prices spike within weeks. Not sometimes, not usually. Every time. That's not prediction. That's pattern recognition. And there's a massive difference. Now let me tell you about Priya. Priya's 34. She works as a risk analyst in Singapore. And while everyone else was glued to the news cycle and either panicking or just hoping for the best in early 2024, Priya was doing something different. She was watching ship traffic data, which, by the way, is publicly available, free. Anyone can access it. And she noticed something interesting. Tanker routes were quietly shifting. Ships that would normally go through the Strait of Hormuz and up through Suez were rerouting, all the way around the Cape of Good Hope at the bottom of Africa. That's an extra 6,000 nautical miles per trip. More time at sea, more fuel burned, more cost per voyage. Ships don't do that for fun. They do that because someone on that vessel, or the company operating it, has decided the risk of going through the strait isn't worth it anymore. That's information. Real, actionable, leading information. So Priya didn't wait for a CNN headline. She didn't wait for her advisor to call her. She quietly moved a portion of her portfolio into energy sector ETFs and some shipping-sensitive positions. Before the mainstream press ran a single story about it, XLE, that's the S&P Energy ETF, ran up 18.3% in that window. The S&P 500 as a whole, 4.1%, same period. Priya didn't predict the conflict. She read the structure. She followed the ships, and she positioned before the panic. That's it. That's the whole game. Okay, here's where we get into the actual meat of this. I'm going to give you the exact framework, real steps. No vague advice, no do your research hand-waving. I call it the Hormuz Heat Map. 4 signals. You check them once a week. When 3 out of 4 of them are lighting up at the same time, the structure is primed. That's your window. Signal 1: naval movement. The US Navy actually publishes ship movement data. Defense news sites like USNI News track carrier group positions and update them regularly. It's public. When 2 carrier strike groups move into the Persian Gulf simultaneously, and I want you to remember that detail from the beginning of this video, that is not a routine exercise, that's a signal. Bookmark USNI News. It takes 2 minutes to check. Signal 2: tanker traffic deviation. Go to marinetraffic.com, completely free. You can watch live ship movements on a map like you're tracking flights on FlightAware. What you're looking for is tankers rerouting. If you start seeing a significant chunk of vessels, 15% or more above the 90-day average, choosing the long way around Africa instead of going through the strait, pay attention. Because those ships are costing their operators an extra $1 million to $2 million per voyage to avoid that route. They are voting with their fuel budget, and they know more than you do. Signal 3: futures curve inversion. Okay, this one sounds technical, but stay with me because it's actually really elegant once you see it. Normally, oil futures contracts for months further out in the future cost more than oil right now. That makes sense. You're paying for the cost of storage, delivery time. That's called contango. It's the normal state, but sometimes the curve flips. Near-term oil starts costing more than oil for future delivery. When that happens, when the market is willing to pay a premium for oil RIGHTNOW versus oil 3 months from now, that's the futures market essentially saying, we think there's going to be a supply squeeze very soon. That's called backwardation. And you can check it for free on the CME Group website under WTI crude futures. When you see that curve invert, the structure is primed. Signal 4, Iranian rhetoric. I know, this one sounds like I'm asking you to become a foreign policy expert. I'm not. All you have to do is skim Reuters or AP maybe twice a week and just pay attention to what Iranian officials are actually saying publicly. There's a difference between we will respond to any aggression, which is basically background noise at this point, and Iran naming specific shipping lanes, specific military assets, or specific time frames. That's second category. Historically, that language shows up within weeks of a physical incident. You don't need to be an analyst. You just need to know the difference between noise and signal. So that's 4 signals: naval movement, tanker deviation, futures curve, Iranian rhetoric. 3 of 4 lighting up at the same time, that's your trigger. Now what do you actually do? Here's the playbook. I'm going to break it into 3 tiers because people have different risk tolerances and different portfolio sizes, and I want this to be useful for where you actually are right now. Tier 1, if you're conservative. When 3 signals activate, consider rotating somewhere between 5 and 8% of your portfolio into an energy sector ETF, something like XLE or VDE. You're not making a wild speculative bet. You're just acknowledging that the structural reality has shifted, and you're tilting slightly toward that reality. That's it. That's the conservative play. Tier 2, if you're moderate. In addition to the energy ETF, look at tanker shipping stocks. Frontline DHT Holdings, Nordic American Tankers. These companies literally make more money when routes get longer. Think about that for a second. When ships have to sail 6,000 extra nautical miles because they're avoiding a crisis zone, these companies bill more per voyage. More days at sea means more revenue for them. So a crisis in the strait is not just bad for some sectors. For tanker operators, it's a revenue event. Most people never even think about this side of it. Tier 3, if you're comfortable with more risk and you understand options mechanics. USO, the US Oil Fund ETF, has liquid options chains. If you know how to buy calls, the signal framework gives you a structural timing edge that most retail traders don't have. I'm not going to walk through options mechanics right now. That deserves its own video. But I want you to know this lane exists, and here's why all of this matters so much. When the Houthi attacks escalated in December 2023, all 4 signals lit up within a 3-week window. 3 weeks. Someone running this framework had 3 weeks to position before the mainstream media panic. 3 weeks before retail investors started piling in and pushing prices up. That gap, those 3 weeks, is the difference between making money on a macro event and just watching it happen to you. Institutions aren't smarter than you, they're just watching different signals. Well, now you're watching them too. And look, most people who watch this video will stop right here. They'll feel informed. They'll feel like they got value, and then they'll close this and go back to whatever they were doing. But what I'm about to tell you next, this is the part that actually separates people who use this information from people who just collect it. Keep going. Okay, I want to talk to you directly for a second. Because I know exactly what some of you are thinking right now. You're thinking, this sounds really complicated, or I'm not a professional. I can't monitor 4 signals and track Iranian government statements. I have a job, I have a life, or maybe, this sounds like speculation. This sounds risky. I don't want to mess up what I've already built. And I hear you, those are real concerns. But I want you to sit with something for a moment. Who benefits when you believe this is too complicated for you? Think about it. The financial media makes money keeping you focused on quarterly earnings, on which stock is hot this week, on whether to buy or hold or sell based on someone's opinion on television, because that's their game. And when you're playing their game, you're in their ecosystem. Macro supply shock risk, the Hormuz equation, doesn't fit neatly into a segment. You can't package it into a 30-second take. It requires context. It requires history. It requires connecting things that don't seem connected. And so it just doesn't get covered. Not because it's not important, because it doesn't serve the people who control the content you consume. Here's the truth about the framework I gave you. 4 signals, 20 minutes a week. That's the actual time commitment. You're not becoming a geopolitical analyst. You're not reading classified briefings. You're checking 4 publicly available data points once a week, the same way you might check the weather before deciding what to wear. And here's the thing about complexity that nobody says out loud. When something feels hard, when there's a learning curve, when it takes a little effort, most people stop. Like most people genuinely just stop. And that stopping, that's your edge. Because on the other side of that small amount of friction is information that the average retail investor has completely ignored. You're already ahead just by being here and finishing this video. And the real risk, the actual risk I want you to think about, isn't in learning this framework. The real risk is being the person who says that's too complicated for me, and then spends the next decade watching their portfolio take unexplained hits every time something happens in the Middle East, without ever knowing why. That's the risk nobody talks about. Okay, I promised you something extra, something I didn't mention in the title. Here it is. I call it the Petrodollar Divergence play, and this is something you can genuinely go look at tonight. Here's the piece most people miss. Oil is priced globally in US dollars. That's the petrodollar system. It's been this way since the S. Every country that needs oil has to buy dollars first, which means when oil gets squeezed and demand spikes, the dollar temporarily strengthens. Now here's where it gets interesting. When the dollar strengthens, especially in a crisis situation, it puts enormous pressure on emerging market economies. Countries like Turkey, Brazil, South Africa, they've borrowed a lot of money in US dollars. When the dollar gets stronger, their debt gets more expensive to service. Their currencies weaken. Their stock markets drop. This is a second wave of impact that happens almost every time there's a Hormuz tension spike, and almost nobody in the retail investing world is paying attention to it, but there are ETFs designed specifically to move inversely to emerging market weakness. And historically, they've had a strong correlation with the same crisis windows where energy ETFs are running, two plays activating in the same window. Most retail investors only ever see one of them. Tonight, here's your actual action step. Open TradingView. It's free. Pull up the ticker XLE, then pull up FRO, then pull up EEV. Now overlay all three of them against WTI crude prices during three specific windows: the 2019 Hormuz tension spike, the 2022 oil shock, and the 2024 Red Sea crisis. Just look at it. You will see the pattern with your own eyes. You won't need to take my word for any of this. The chart will just show you. That's your homework tonight. 15 minutes free, so let's bring this home. Here's what you now understand: that the vast majority of people watching financial content, even people who consider themselves financially literate, genuinely don't. The Strait of Hormuz is not a geopolitics story. It's an inflation story. It's a cost of living story. It's a portfolio risk story. It is a story about your money, your groceries, your interest rates, and the fact that all of it can be influenced by what happens in a 21-mile stretch of water, controlled by one country with one barrier arm. And now you know the signals to watch. You know the structure. You know how to position before the crowd figures out what's happening. That's real. That's actionable, and most people will never take the time to understand it. But here's what I need you to sit with. The Hormuz framework is one choke point, one vector, and the world is full of these hidden levers that quietly shape your financial life, that nobody in mainstream personal finance ever connects to your day-to-day decisions. I made a video that pulls back the curtain on 12 of them. 12 things the middle class has been told are smart, safe, wealth-building moves that are actually quietly working against them. Things their parents believed in, things their advisors still recommend, things that sound responsible but have a completely different effect than most people realize. If this video changed how you see things, that one will change how you see everything. Go watch it.